When you get into portfolio theory and quantitative analysis, one of the first things you'll realize is that someone telling you their percentage return means almost nothing when it comes to evaluating their performance. Yes, you heard that right. Just hearing a strategy's percentage return is not giving us enough information. Here's a hypothetical. Look at this chart. We have two strategies, strategy 1 in blue and strategy 2 in orange. They both started at $10,000 and both ended up at $15,000. If you only cared about returns, you'd have to argue that there's no difference between these two strategies and that you might as well flip a coin. But we know that's not true. Strategy two's worst drawdown was 27%, while strategy one's worst drawdown was just 4%. So the journey to get to that 50% return is wildly different between the two strategies. And you might say, Josiah, I'm an aggressive investor. I don't care about drawdown. Well, I would believe you if you put every single dollar you saved into the market. But the odds are that you're not doing that, because you know that the market could possibly be down as much as 50%, like back in 2008. So you're perpetually keeping some amount of money in a savings account because you know that in the market, there's always that drawdown possibility. Now, why am I bringing this up? Well, think about this. If you had a strategy that you knew would match the returns of the S&P 500, but its biggest drawdown would only ever be 10%, wouldn't you feel comfortable putting a lot more money into it? This is why professionals care about risk-adjusted returns, not just returns. If you can get the same return with less risk, then you can allocate more capital to that strategy. And once you understand that, you'll start to understand why investors care more about risk-adjusted returns than returns alone.